Testing, testing. Sounds good. Can everyone hear me well? Yes?
Testing.
Yep. Can we start?
Yep.
Yeah. Xiaochen is on the line? Yes.
This
Okay.
one also.
All right. Hello, everyone. Welcome to the session on green debt innovation, emerging technologies and strategies for sustainable economic growth. I'm Kristina. I'm with WWF and based out of Singapore, and I head the Asia Sustainable Finance practice. And with me today is we have Alexey from Evercity. He's the CEO. Then we have Krista Tukianen, co-founder and chief commercial officer at ClimateAligned. Then we have Simone Utermarck. And Simone is with the International Capital Markets Association. And last but not least, well, no, actually, we do have one more speaker online. The last speaker in the room is Mohsin Sharif, Senior Capital Markets Specialist at the Islamic Development Bank. And last but not least, online, we have Xiaochen Zhang, who is the CEO of AI 2030. So today we're going to talk about, first of all, can you tell me, for those at least in the room, who is from a finance background here? Okay. And from a tech background? Right. And I think we have two people which are unknown, but do you want to share what area you work in? Okay, never. All right. So maybe just for context, because we have people from varied backgrounds, today we're going to talk about green bonds and debt in general. So in 2008, the World Bank issued the first green bond ever. And since then, hopefully, today from the conversation, we will see in 15 years how green bonds as instruments have been evolving, how the market has been evolving. And some people are saying that actually green or ESG investments are mainstreaming, because I think in terms of size, last year it was about 3 trillion. But I think the question also that we need to address today is it scaling at the speed we need, given the huge climate and biodiversity financing gaps that we have at the moment? Looking at the global biodiversity framework that launched last year and specifically Target 19, looking at how do we actually structure this financing, and more importantly, how do we direct this financing where it's supposed to go to emerging markets, where it's sometimes challenging or expensive for these countries to fundraise, and various different players as well. So without further ado, let's kickstart the conversation. And I'd like to start by asking just all of the panelists to share a little bit more about what you do, your organization, and how are you working on green debt or green debt innovation. Perhaps Alexey, do you want to start?
Yeah, thank you, Kristina. Hi, everyone. So in Evercity, we are focused on helping developing countries accelerate access to climate finance. And we're trying to make climate finance more, simple and easier for those actors in developing countries to operate with. We have two verticals in our platform, the carbon vertical and green debt vertical. And on both of these verticals, we are providing a project management workflow that helps to streamline the structuring of those assets, and also the issuance using digital tools, as well as further on monitoring and reporting. Thank you.
Hi, everybody. So I wear two hats. One is with the Climate Bonds Initiative, which is a sort of green standard setting organization, not dissimilar to the ICMA, which we'll hear about in a minute, as senior advisor. And I'm also, the sort of day job is one of the founders of ClimateAligned. And similarly to Evercity, we tried to simplify the climate investment process for buy-side asset managers and sell-side bankers. So we use technology to help them uncover and interact with the kinds of data that they need to make decisions on whether something is credible and aligned to any framework of their choosing. So we take some of the good thinking from ICMA and others, standard setters, and help folks to deploy that faster, and using large and small language models, in case there's anyone in the room who's heard of those. Trying to sort of speed up the flow of capital to where it needs to go.
Yeah, hi everyone. I'm Simone Utermarck from ICMA, International Capital Market Association. You also hear ICMA sometimes, we say both. So we are a trade association. And one of the things we do is sustainable finance, which is the area where I work in. And what we are known for there is, well, we do different things, but one of the longest standing things that we are doing is that we provide the secretariat for what's become known as the principles. That is the green bond principles, social bond principles, sustainability linked bond principles. So basically the market standards that have come to underpin the global sustainable bond markets. And what we do on innovation, well, we continue to work. We are actually involved a lot, but we are not the ones creating the principles or updating the principles. We are working with the market, with an executive committee consisting of issuers, investors, and underwriters in those sustainable bonds. And every year, the year is not the annual year, until June, when we have our AGM and annual conference, we work on updates or new principles and all of these things. We look at what needs to be innovated, if you will, as well, and not just updated, together with the principles executive committee based on what we see in the market.
Good afternoon, everyone. Thank you for having me here. I'm Mohsin Sharif from the Islamic Development Bank. You see the World Bank, you see the African Development Bank, and then you have the Islamic Development Bank. We work on 4 continents, so not a regional development bank. It's a AAA rated supranational with a mandate for sustainable development in our 57 member countries across the continents. So sustainable development, food security, knowledge creation and sharing, as well as climate finance is part of our mandate and strategy. I am from the Treasury Department, looking at the issuance of green Islamic bonds, which are referred to as sukuk, so green sukuk. And these are the instruments that we issue to mobilize climate-related funding. And we'll talk about that in a bit.
Super. So I think one of the questions that, you know, is quite interesting, and what we at WWF have been trying to tackle, is how do we actually find the right funding type and funding instruments to match the products or projects and companies that are available to scale impact. So a lot of the discussions that we have with institutional investors, they're, let's say, barriers to participating in green finance is things like, unfavorable internal rate of return, or the regulatory requirements as barriers. So perhaps maybe Krista and Alexey, I'd like to ask you, what are some innovations, or how can tech solve those issues? And are those really barriers that really do exist? And do you see any solutions that already exist to these?
So I'm talking about developing countries. I think one of the main barriers is the knowledge barrier. So, speaking about green debt, it's a very complicated issue, and debt also you need to be like a financial market professional, and green debt is something that goes on top of that. So there are principles, there are standards, and for most of the people, maybe also at COP for developing countries, this is something very new, and they don't have the expertise, they don't have the time to dig into that. So the only way for them mostly is to work with special financial partners or consultants that help them to understand that. And one of the solutions here, maybe that's a simple solution, but we help them by by some Q&A, by some screening, like automatic screening tools that we have. We help them to better understand whether they're eligible for a certain type of green financing or not, or maybe they should look for some other type of financing. So by this kind of initial pre-eligibility screening that we're doing on our platform, we're helping them to better understand which way to go, actually. And then going further, we're also helping, and there's a tool that's already working, being operational, helping them to create their green bond frameworks. So the documents that describe their green bond issuance, the use of proceeds, and we're trying to explain that, automate that. So again, by describing better their business, they're getting a template that they could share then with professional players, consultants, and auditors to check them. And there are, of course, some other issues, but I will stop there. And
yeah, I think, as Alexey said, a big chunk of the issue in terms of funneling capital through to especially emerging markets is the sort of capacity gap there. But in addition to that, I'd say that when we talk about green debts, that's obviously a big chunk of the capital stack. So bonds are one piece of that. And then we try to fit sort of, a square peg through a round hole to say everybody should issue bonds. That's not the case at all when you don't have a capital market to begin with in some of these countries. So it could be things like green loans or sustainability linked loans or green credit lines, for example. And there's a lot of work that's been done by, the Loan Market Association and to some extent also ICMA to help facilitate sort of the initial capacity building on that front. And then, of course, the bankability side, it's a barrier when you either, first you're struggling to uncover the projects that you could or should be financing in alignment with some of these regulated or recommended frameworks and taxonomies and kind of other thinking that is precluding access to international capital markets because that's what institutions want. But then also these projects may not be bankable to begin with. So enter blended finance, which is probably going to be the term of this COP28 or this COP, I hope. There are definitely, I think, interesting initiatives also on the tech side in terms of helping institutional investors figure out how they can participate in blended finance, and that some of that is just traditional collaboration, going to talk to ISDB and going to talk to some of the direct donors as well, and sort of understanding, what de-risking and concessional finance can actually look like. But beyond that, I think it's, many institutional investors in the developed world can do more already with whether it's tech-enabled or just kind of direct outreach to some of these institutions that want to be doing the right thing and maybe starting, you might have a financial institution in the Middle East or North Africa or Southeast Asia or South Asia that is just starting on their climate journey. So having those conversations directly as an institution that can then help, really push them forward on their journey is quite beneficial. And I'd love to hear, other panelists' take on how that's actually happening on the ground and how some of these industry frameworks are being used to facilitate that.
Well, I think there was a lot in both that you said. So I want to circle back to a few points, mainly around kind of, what you said about the first movers and how they're doing it and perhaps some examples later. But before we go into that, I do want to ask Simone if you could speak a little bit more about ICMA's green bond standard and what are the kind of standards, the principles, the benchmarks that you put out, and how have you seen adoption and demand in those from investors, and how are these helping in cases where we need to measure impact and also measure the credibility of the instrument?
Yeah, so the principles, so we call them the principles, and but they are, as I said, the de facto global market standard. We've looked at the global bonds for the last 3 years, and every year it's about 98% of the global sustainable bonds market aligned to those principles. So they really are the global standard. We have the Climate Bonds Initiative. They're basing their taxonomy on the principles, and then they're layering that, being a bit more granular and a bit stricter on the greenness of projects. We also have in the EU Green Bond Standard is based on the GBP, as we call them, the Green Bond Principles. So they have become very popular, and we think that's because they are created by the market, as I previously mentioned, by issuers, investors, and underwriters for the market. So they're not created in a dark room somewhere. And because of that, they really have the finger on the pulse of the market and always incorporate, where we see there is something happening in the market, or there is a new issuance back in 2019 when we saw Enel as the first one to come out with a sustainability linked bond. Immediately the ExCom gets together and thinks about it, whether, there should be principles helping with this market, helping guide this market. We're not regulating the market, but we're guiding the market. In addition to the principles, there's also a lot of guidance around it. One of them, or two of them rather, because it's both for green bonds and social bonds, is on impact reporting. The principles for use of proceeds bonds, which are green and social bonds, because it's important where the proceeds go, have 4 pillars, and the 4th pillar is on reporting, allocation, and impact reporting. And impact reporting is really the part where I would say this is the link to the real world. This is increasingly important to investors, because that's where they can see if their money is doing any good. What are they achieving with their money? What is the issuer doing with their money? And most importantly, what is the outcome, and the difficult one to measure, but the one that people want to know about, the real impact. Has it really improved anything? So this is where the guidance can help, and it's still it's getting better and better, hopefully, but issuers are still grappling, I think, with the standardization of this, because it's also a lack of data sometimes, but we might come to that when we talk about innovations as well.
No, absolutely. Lack of data. And also, impact measurement can also be quite a costly exercise. So hopefully we can find out later as well how technology can help to lower those costs. Mohsin, I think you can obviously speak to actually a very practical way in which, through the Sukuk that you mentioned, you implement the green bond principles that Simone just spoke about. But I do want to actually ask you more about these types of sukuks, which is basically a bond-like instrument, which is Sharia aligned. So it's really, something quite innovative in the Islamic finance world. And Malaysia, actually in 2021, I think the Malaysian sovereign issued about a 800 billion, I think, debt instrument. And obviously the Islamic Development Bank issued an even larger amount. It was a 2.5 billion, right, in size. So can you tell us more about what is a sukuk, and also can these instruments help to tap into Islamic capital markets?
Sure. So yes, as you mentioned, sukuk is the Islamic equivalent of a bond, where the instrument is structured similar to a bond. You get your coupons on your coupon dates. What is additional in a sukuk structure is the ring fencing of the proceeds for specific assets. So without assets on the ground, and in this case for a green sukuk, green assets on the ground that can be classified as green as per the criteria set by ICMA, is where the proceeds will be utilized. So this gives additional comfort to our investors that this is where the proceeds are being used, and this is the level of details of results that will be reported to you. So we have tapped into new universes of investors with this kind of instrument, where the interest is peaking, where they are not just looking at sukuk as a bond instrument, but also as a green instrument. And this has helped us unlock new investors, especially in Europe, where Islamic finance is gaining traction. And at our end, in terms of green and sustainability sukuk, we have issued more than $5 billion to date in the past 4 to 5 years. This is just a result of our commitment to making climate finance a reality for our member countries, and having those projects on the ground that are being approved year in, year out. We have a climate finance target of having at least 35% of our annual approvals for climate finance projects by 2025. We have already reached 33% of that. So that pipeline of green projects is also increasing, and it only enables us to issue more green sukuk and mobilize climate related finance for this. For sustainability sukuk, we have a social component as well, which is where you referred 2.5 billion issuance in March 2021, where 90% of the proceeds will be allocated and ring-fenced for green projects, and 10% would be for social projects that were pandemic related and healthcare related, coming out from the impact of the pandemic. So what we have done is taken this instrument and then showcased it to investors that this is the bridge, call it a platform for them to get exposure to these countries. Half of our member countries are least developed member countries in Africa. They won't go directly there in these countries. So ISDB provides that platform in a bond structure with green label. The comfort is there for the investors, and the response has been tremendous since then. What is now happening is on the reporting side, where we are following the ICMA principles, is that the level of detail from our project portfolio and the details of the projects from the ground are being reported in an annual impact report. And not only is our report published on our website, we have that report externally validated as well, to give that level of comfort to the investors that these are aligned with the framework as well as the principles, so that the investors know exactly what they are looking at, and then the investors are able to report to their stakeholders about their dollar and the impact that it is making.
Well, that's fantastic, and transparency is key. So you mentioned, we talked a little bit about climate and social indicators already, but perhaps I want to also ask all of you, how do we actually enable finance for the global biodiversity framework and the 2030 targets? And, we're still kind of grappling between making finance accessible and structuring it in the right way for climate-related instruments. So how do we do that simultaneously and together for nature and biodiversity? Are you already seeing movement in this space? Are there any examples that you can refer to? Does anyone want to start?
Well, I would, of course, speak from a perspective of the sustainable bonds market again. And you can finance biodiversity under the green bond principles, because what green should really be understood as is environmental, right? It's environmental objectives. Under that, you have biodiversity. We also have blue, for example, which is ocean finance. We also see some freshwater bond related issuances. So that belongs to nature as well, of course. So you can actually finance that. You can raise finance with a green bond and then select the projects accordingly. But of course, there are always investors out there and issuers as well that want a little bit more clarification, which is, for example, why in September, ICMA was involved in a blue guidance together with MDBs and UN organizations. Which basically clarified that, yes, you can already issue a blue bond under the green bond principles, but just provided a table, for example, where certain things were made a little bit more explicit. To give you an example, the green bond principles list as an eligible project category renewable energy. In the blue guidance, it says marine renewable energy. Now, that sounds kind of obvious, but it just clarified the fact that you can indeed use that.
Maybe I can just add to that a few examples. So definitely in the years within climate bonds that we've been looking at the whole market, sort of, taking as a starting point the bonds and other debt instruments that are aligned with the principles, and then looking at the details of the kind of granular use of proceeds and the impact data as well, which is crucial to sort of substantiating the governance promises that are made at the outset. We've seen biodiversity and nature-related projects all the way from the kind of blue bonds from, for example, the government of the Seychelles, which was the first one, I think, that used the blue bond in a sovereign deal, where they were looking at marine protected areas and kind of different ways of restoring marine ecosystems, and also mangroves as a kind of climate adaptation with obviously lots of biodiversity co-benefits, to even the US muni bond market, where we've seen afforestation and forest restoration projects under municipalities. But it is still really at the fringes in terms of the kind of volume of capital that moves through that sort of DCM structure, and especially in bonds, again, because these projects, as Mohsin was saying, just uncovering the project pipeline and then packaging that into an investable instrument that has the right kind of credit rating and the right kind of other qualities, that it actually fits within your usual buyer's mandates. And it's really great to hear, by the way, that your investor base is broadened and probably becomes stickier as well. You'll have the same buyers lined up when you go to market again. That's hard for nature and biodiversity related work, because we don't have a way of sort of obviously valuing those assets on their own just yet. And one could argue that the same goes for carbon as well to some extent, but it's much easier to do that for a renewable energy project than for something that doesn't yield an ongoing benefit. So payments for ecosystem services, things like that, where we actually generate then a cash flow or put a value on some of these nature related assets, can be helpful. But yeah, not seeing a huge amount of progress on that yet, and we can think about how to unlock some more of that as well.
Yeah, just to add, biodiversity related assets have been picking up. However, the pace is slow because of the regulatory aspect as well. And the standards have to be very clear to the investors as well as to the issuers. That will help inform the design of those projects, because then that is what we can use as the pool of assets for our issuances. And I think the scientists are working, but the financial industry, the financial stakeholders also have to speed up this aspect and try to get more involved. And their operations for our example, our operations colleagues need to have that clarity of including these indicators at the design level, so that they are eligible as per the principles when they arrive, so that it makes it easier for our issuances. So that's the trajectory that we can see from where we stand right now.
Great, thank you. And then just thinking in very practical terms, baking those into the requirements and so on into the instrument is important, but how do we have the data to do that? And I know this has always been a chicken and an egg type of thing, right? Should we start because we don't have the data? And, if we don't have the data, then, how can we tackle this issue? Are we not doing more harm than good if we don't have sufficient data? So what are some technological solutions that can be employed already for biodiversity? Because again, for carbon, we have one metric. For biodiversity, some stakeholders are pushing for one metric as well, not getting too technical, but specifically an MSA or measuring abundance of biodiversity in a specific area, which, at least as a science-aligned organization, we believe that that's not enough, because, there are many other things in biodiversity that need to be considered and baked ad hoc per project and measured. So just speaking to that and the various matrix and the very location-specific information that one needs, because biodiversity in one area for one project will not mean exactly the same thing in another area. So how can technology help? What exists? And how can perhaps this process even of data collection in a way be automated and helped?
There's about 1,000 ways I could answer that question. Well, let me just start by saying there's a difference between saying we want to invest with positive impact only versus try to find the sort of entities and actors that are doing the best that they can against a very challenging backdrop and moving on some kind of pathway. And we do the same with climate, by the way. So when we think about mainstreaming these solutions, we can't just rely on labeled bonds and loans and other debt instruments, which are obviously a key component of this. But where we start to see interesting uses and kind of use cases for the data that already exists is in the broader debt capital market. So I personally don't think, and obviously from ClimateAligned's perspective, that it's necessarily about the lack of data as such, though there are obviously gaps, but there are gaps in accounting data as well. We can't afford to just sit and wait for the perfect framework and the perfect disclosure data to emerge. We've been doing that since the GRI became a thing in early 2000, and we're still almost in the kind of starting point debating over which is the best framework. So my kind of thinking on this would be, how do we interact better with the data that does already exist and understand, how things actually look in context with the kind of guidance that's coming from the market, the science-based pathways that do exist for climate, which isn't just carbon, though that is obviously the most common metric, but all of the messy qualitative transition-related data that you have to understand when you're saying, is this institution or this bond contributing to a transition to a net zero, climate resilient world. And that's by nature a subjective and qualitative judgment. And I think that's the same for nature and biodiversity, which is why we're now starting to see, for example, the TNFD, the Task Force for Nature-Related Financial Disclosures, published their framework at New York Climate Week at the mid-September. And we did a benchmarking exercise using our tooling on TNFD signatories, about a couple hundred organizations. And there are already plenty of, and this is real economy corporates where you can uncover data that looks like it maps pretty well to the TNFD framework. And you can already, as an investor, start to make decisions off the back of that, if you will, finding the least worst or the best out of a bunch of companies that have a long way to go. So I think there's this sort of, let's figure out what context looks like and how we can mobilize the data that we already have, and then try to fill the gaps for the positive impact outcome related work, like, specific bonds. And I think Sukuk is a great example because you've already, as Mohsin said, identified the pool of assets that you're going to invest in. So the kind of impact reporting piece becomes easier. But there's still, of course, then technology that we can lean into, like remote sensing and satellite imagery and all these kind of things where you can automate some of the data collection. But I'll stop there because this is something where we could go into a lot of different verticals, and I'd love to hear from the other panelists what thoughts that provokes.
Yeah, so just briefly, I agree with Krista that we shouldn't let the perfect be the enemy of the good. So, don't wait around for data. We have a lot of data already. We need to work with what we have. And then gradually, of course, there will come better data, more data, but also better data. Firstly, before we talk about, digital solutions, we should say that, it's important for there to be frameworks. There needs to be regulation, but there need to be voluntary reporting frameworks as well. So we have the ISSB globally now by the IFRS Foundation. We have in the EU specific under the Corporate Sustainability Reporting Directive, the ESRS is being created. So all of those will help investors get the data that the issuers, the companies have to report. But then also we see, of course, technical solutions coming in. Again, in the EU, for example, they're creating the ESAP, the European Single Access Point, where all that reported data is then going to be stored in a digitally. So in a machine, it also has to be published in a machine readable way. So it's not going to help us get more data. It's just going to improve the quality and the efficiency, the way that we work with it. And also on the, I kept talking about impact reporting. And as Krista mentioned, yes, indeed, for impact reporting, we also have the geospatial data, for example, where you can see, and I think WWF published a report on that as well, where we can see from space really where is impact being achieved, but also where is harm being done, for example. So things like that, we basically can control the data better and just validate it better.
Yeah, I do agree with all the statements here. In our platform, we see, our mission in working with those brilliant digital MRV providers that, some of the methods were mentioned. They're emerging in a very rapid space. So, for example, for biodiversity, at the last COP, the Singapore Pavilion, a brilliant solution was presented that uses audio, data capture from the forest to identify, the various mix of species on, a certain land territory. And there are more and more innovators here. So this progress, it goes like up pretty fast. And what we, where we see our mission is to bridge that with standards. So we are trying to, integrate with those data. We're not, doing the MRV ourselves, and trying to transform and refine this data so it can be, applied for the bond reporting according, all the standards and frameworks that exist out there. So that's our take.
Should have spoken before Alexey, because I was going to throw some water on this. You see, in our experience, there are green rating agencies that assign ratings to our frameworks, which we then showcase to investors. So it shows our commitment and the level of integration of green policies and climate related policies in our financing portfolio. So what we have witnessed is that these rating agencies, unlike the credit rating agencies, have different interpretations of data. which we have internally, which we share with them. So there is an urgent need to standardize that as well. But again, a balancing act has to be done where the local context also has to be taken into consideration, where some regions are different and other regions are, for example, the EU is a completely different place to Africa or Southeast Asia. So this is where, tech players will need to work together with the industry to have that balancing act, but also to make sure that integrity is maintained throughout the process of data collection, measurement, as well as reporting.
I just want to comment on Mohsin. Thank you for mentioning the magic word of standardization. I think Simone did as well previously. You mentioned that the European single access point. I think it's a great development, but that data won't become available until the end of 2026 earliest, or maybe 2027, and it will cover EU entities. Mohsin made the very valid point that context matters so much when it comes to both what is being asked of entities and bond issuers in sort of this context, or kind of debt market participants to report, but also the regulators and the policymakers will have, because of that, a very different view. We have, what did you say on your panel yesterday? Something like 30 global taxonomies now, or maybe even more?
Last thing I read was 31, but it's probably more by now.
Yeah, exactly. And then lo and behold, every single buy-side asset manager has an in-house taxonomy that's some kind of combination of all of these things. So you're doing all this good work. Green rating agencies or SPO providers, second-party opinion providers, external sort of verifiers are doing all this good work to put a view on this. And then the investors will overlay their own view. So again, being able to interpret the data that we already have is key. And that's also, well, that's what we're working on, and speeding those workflows up for the buy side to say, well, can you make a judgment on this? Do I, have faith in Mohsin and his good colleagues that this is legit from my perspective? Because their views are then informed not only by the regulators, because most of these green market rules aren't yet enforceable as law, they're still guidelines, but also my asset owners whose money I manage. So if there's a big pension fund saying, nah, I really don't like nuclear energy or waste energy in this particular region, then that's not investable. So I think that's where, we're never going to get to a perfect standardization because everybody's going to have this subjective view. And that's where I think some of the tech solutions that we're working on, but also the kind of practical market implementation can work together to say, well, how do we make the best fast out of a very messy situation that's going to be naturally in flux as the climate changes and kind of, nature impacts are being felt as well.
Yeah, no, I just wanted to briefly say what Mohsin mentioned on ESG ratings. That's another area where we see currently a lot of voluntary codes of conduct. We ourselves, ICMA, provides the secretariat for a voluntary code of conduct for ESG ratings and data product providers, but also regulation in the EU sort of appearing everywhere, and all of that based on the IOSCO recommendations on 2021. So this is another area indeed where we have the data, we have the ratings, but they're not comparable. And because of that, of course, ratings are so important, right? And if it's like apple and oranges and you can't compare them, then it's often not that helpful.
Yeah, but I guess the main message is we need to start, even with the differentiation, kind of the apples and oranges, we do need to start. And I think one thing that we're seeing, to speak to what all of you just said, is that, I think capacity building is one important area here, at least for us to start to, in a way, consolidate. And also tools are something that are extremely important, because after the capacity building, I think we've had many situations where folks go, they learn the theory and then they go back to their desks and they're like, where do I start from? How do I even start to implement what I've learned? So tools, for those of you that mentioned you're in tech and the founders here, I think tools in this space to help automate and kind of to consolidate data, but also tools that can solve for that discrepancy in the various conversations and regions and matrix, I think will be key in the future. But maybe with that, I'll just stop for a while and see whether you have any questions for the panelists before we continue. You're very comprehensive. Well done.
Thank you. My name is Hassani. I'm a data scientist anyway. So pure data scientist all my life. When you are talking about the data, the quality of data is one aspect. The proxy that currently we are using in the different, maybe you can use come up. And that's the issue of data is not just in this case. Even in whole life of climate and any other industry, we have this issue. But one of the particular important aspect I would like to mention is data governance. Because if we have a data governance in place that UN 2 months ago issued about this, then we know that, for example, in the EU, because of the OECD, each state, they have to report the data, while rather than EU, we do not have this. So if we have data governance in place, gradually we will see the data, but the quality data, coverage, timeliness, and also multi-aspect of the data that fit into your system. Thank you.
Thank you, Krista. I anticipate you want to take this.
Absolutely. Yeah, I agree. I just don't think we're going to get there fast enough. So we don't have, full comprehensiveness. We don't have timeliness, and the quality is an issue, which is why we lean into these small and large language models that have specifically been trained and tuned on climate relevant data, where you can then start to interpret something more structured out of something incredibly messy, and also picking up the signals as they emerge, because it's not just the reported data. It's when, say, a company that is issuing bonds acquires another company that is doing something beneficial to their transition pathway. That's a signal as well, and that can become multiple data points, if you will. So I think that's exactly why we're leaning into building these tools, because there's an obvious use case for, obviously, founders always drink their own Kool-Aid, so take this with a pinch of salt. We think there's an obvious use case for the use of technology here to just cut through some of the cognitive load that is being imposed on all of the market participants to figure out what is going on at any given moment, and then try to maintain some of these timely data sets. And especially when the rules or the guidance changes, as it should, given, ICMA or others with the convening power to bring market participants together and talk directly with the regulators. As the context evolves, so should those data sets, and so should those workflows. And that means reassessing on the coverage point, potentially thousands of bond issuers and their bonds, tens of thousands of instruments at, potentially monthly intervals. Are we really going to use human time to sift through all of those documents? I don't think so. So that's where I'm sort of optimistic and excited by the sort of convergence of a lot of the things that this panel is working on, from a standard setter, regulator, NGO, and then kind of the technology and the market participants' point of view.
Any other questions? Yeah.
Thank you very much for very detailed and very informative panel intervention. From practical perspective, do you see anything from, let's say, regulatory, financial, or legal incentives that would be aligning the interests of the stakeholders in the green bond issuing and circulation process? And let's say a hypothetical scenario where, for instance, we have green hydrogen project announced, adhering to all these principles, well issued, received by the investor community. But let's say 5 years from the closing moment, all of a sudden the company says that instead of, I don't know, doing this with solar energy, they are just refractoring all this petrol output, and that ultimately, let's say, financially creates positive impact on, let's say, debt service coverage ratio. So there is no problem from financial perspective. It's definitely massive blow to the credibility and overall sustainability of this document. But in that situation, when, well, let's say, hypothetical pension fund who was holding this green bond tries to drop it in the market, of course, there will be some vultures, buyers who will try to arbitrage it and then buying at, I don't know, 70%, ultimately holding to maturity and reaping pretty nice yield to maturity as a profit. So coming back to the question, how would you see what would already be observed in the markets as a practice, as a good practice of real incentives, not some sort of a big announcements, which, well, definitely nice thing to do, but beyond that, legal, structural, financial, regulatory, I mean, these kind of things either already in place or maybe desirable to go forward and then pitch it to the central banks, to the legal communities, etc., etc. Thank you.
Thank you. Do you
Yeah,
want to
maybe-
use that mic? I think there's another question.
Hi, good afternoon. My name is Harish. I am from India. I represent National Stock Exchange. India is around short of roughly 30 billion year on year for the green financing, and green bonds, in fact, is a venue we are exploring a lot. But off late from last, in fact, we raise around 3 to 4 billion every year. But off late, we are saying greenium is not there. So most of the government PSUs or companies are not going for green bonds because green is missing. So my question is to Mohsin and other panelists. Can you give us some idea which are the practices or regulation or policies which will support us to enhance the greenium so that more and more companies or government or for that matter public sector units can explore green bond option, because we need green bonds in India. Thank you.
Okay, maybe I'll go first because I'm sort of doing a combined answer. So firstly on what you said, and that also goes a little bit into your area. I mean, if something like that happened, that would be obvious greenwashing, right? That would be, there's no real definition of greenwashing, but it's clearly greenwashing if you intentionally deceive investors. We haven't really seen that. There are greenwashing accusations out there, but the green bond principles, for example, exist or are actually adopted in the market because they provide guidance to issuers, and investors have come to expect that as to what they should put into their green bond framework. They should specify what green projects they're financing, how they have selected those green projects. They also should internally, of course, manage the money, not necessarily ring fence because money is fungible, but as long as you allocate a certain amount of proceeds then to the projects, that's okay. And then you also report on this allocation and the impact, as I mentioned earlier, right? So if you do that, you know, I mean, as I said, what you just mentioned would be an obvious deception. And one of the additionalities that come from green bonds or sustainable bonds in general is that they bring together a lot of very senior people and also other people from different departments in an organization to really think about this, right? They think about what do we want to finance and what's the best instrument to issue to raise that finance. Now, just there sometimes can be a greenium if you have a lot of demand for your issuance, but that's not why they should be issued. And there certainly can't be, you know, I wouldn't say there should be any work done to get a greenium. I mean, that sounds a bit silly. I think there can be a greenium. It's a nice side benefit, but you should really, as I said, you should issue a green bond or another sustainable bond if that's the right instrument for what you want to finance. And what we've seen in India, but also some other areas, we've had accusations of greenwashing where an issuer issued a green bond to finance green projects, but at the same time continued financing of fossil fuels. So that is not perceived well by the investors, especially the international investor community. So all of these things, you know, need to be in the back of issuers' minds. Of course, also there needs to be not just regulation. Regulators in every country can, of course, help the capacity building and the issuance or the building of sustainable bonds market, for example. But there also needs to be something on a policy level, right, from a government and so on. So all of these things have to come together to then help the market grow in India or other places.
So, yeah, as an issuer, I was thinking of solutions, but then the regulator said, you know, the association said, you cannot deceive. Sorry, you cannot deceive the investors. And once you have allocated the proceeds to a certain objective, certain pool of projects that are geared towards positive climate action, changing course is not really the best thing that you should do for your reputation as an issuer. I'm also from India. The potential is massive over there. However, as Simone mentioned, we don't want greenium to be something that discourages the issuer to refrain from venturing into this. It is about the holistic objective of positive climate action for a number of industries. There was an experiment done in practicality by the German government, if I remember, where they issued a traditional bond and a green bond on the same day. And in terms of to assess the greenium as the tenor proceeds, and it didn't prove to be very large. It was very marginal, and so it brought back the sentiment that it's about what your credit is and how the bonds are performing in the secondary market, and not specifically the greenium. So the issuers in India should also focus on the larger objective of driving the transition in India, and leverage on the capital markets, not just in India, but globally as well.
I think technologies can help us get creative here and enable new incentives. We have been working on a new instrument type, which can be called like a carbon-linked bond, or a bond which is appended with carbon credits. And if we're talking about such an instrument, it kind of helps us achieve both aims at the same time. So for the first, so if the money will be used to finance carbon projects, and carbon credits would be originated and then sent to investors, this gives an additional incentive to investors, because there isn't going upside on carbon credits, and they're getting more, the prices are growing since we are approaching 2030. And also, if those carbon credits are issued according to strict carbon standards, that adds from a certain point more complication, because it's another standard that needs to be considered, right? And you need to pass all of these stages as verifications, validations, and so on. But at the same time, it helps to combat greenwashing, because if the right standard was chosen, that means there was a rigorous procedure of making sure that those projects make tangible climate impact. And this is like a double, standard, double verification. This is something we've been discussing with the United Nations Global Climate Change Innovation Hub, which is, led by the UNFCCC Secretariat for a long time. This is something that has been already tested within a BIS pilot project, and this is something that we are now trying to bring to developing countries such as West Africa, and we're starting a partnership under the GCF readiness framework to test out those instruments and see how they can solve those issues that were mentioned.
Just wanted to make a couple of quick points to your question as well. I think you mentioned the carbon-linked bonds. I think another interesting instrument here is the sustainability-linked bond as well, because money is fungible, as Simone pointed out. We have seen the cases where the market does react, for example, to the Adani green bonds that were then kind of dumped by Amundi and some of the other big bondholders, because they noticed that coal was being, new coal-fired power projects were being financed concurrently. And the reality is that that's going to happen in certain geographies of the world. So if you don't know exactly what you want to be financing as you transition, then it's probably better to not commit to the green bond structure, and you want to go with a sustainability linked bond where you set a target at the issuer level and then you demonstrate progress against that. There can be financial incentives linked to that, though I've heard from investors that actually that makes valuing the bond more difficult sometimes, because no one knows where the coupon step up or step down is actually material, and it makes it impossible to put a price on the bond in the primary market. But that is possible. And then on the kind of actual incentive side, central banks and prudential regulators could do a lot more. Green capital requirements, or restrictions on hard to abate capital, for example, or enforcing and imposing climate strategies, transition plans, TCFD reporting, etc., on the buy side and the asset owners as well. So you start to get that push from you actually have to invest in this, because otherwise you can't substantiate that you're moving towards net zero as well. So I think those are some examples, but I would lean into the, we have to do this transition at issuer and at sector level anyway. And then there's the whole capital stack at your disposal. Sometimes a green bond is the way to go, sometimes an SLB, sometimes a loan. I've heard companies, putting all of their revolving credit under a sustainability linkage as well. So there's plenty to go off of, all the way up to the more innovative stuff like the carbon linked bonds as well.
So just to quickly say, there are sustainability-linked bonds indeed, and there are not use of proceeds bonds. There are general purpose instruments, so you don't have to specify where the financing goes. However, that still doesn't mean that you can finance, good stuff and bad stuff. You still have to have, and actually what we recommend, you don't have to use an SLB to finance the transition strategy. Can be, you can use them for other strategies, but if you want to underline what you're doing on the transition side, then you can issue an SLB. But what we recommend is to add credibility to then also look to guidance in form of the ICMA Climate Transition Finance Handbook, where we have key recommendations or key elements rather of what issuers should disclose when they're issuing an SLB or when they're issuing a green bond, even to finance a transition. So you should have a strategy in place, you should have a transition plan, all these things, and you should certainly not at the same time continue to finance coal or other fossil fuels.
Yeah.
Good point. Yeah, it's not a permission to greenwash. So take this guidance from the actual standard setters. And I wanted to add the last point was the greenium should evaporate as this market becomes mainstream. Why should investors pay more? It's only there because there's not enough supply. So, I would much rather see incentives from relevant financial policymakers or even industrial policymakers to cover the marginal, though sometimes significant additional costs of getting the external verification, all that stuff where you have to do capacity building at the outset, because indeed it might be the first time ever that you're bringing together operational departments, treasurers, and sort of everybody to work together to form the program and then actually issue the bond.
Actually, just to add maybe what we've also seen, this is more in the public finance and the kind of the government conversations and speaking to that enabling environment. But an interesting example is actually with things like debt for nature swaps and project finance for permanence. And to your question, how do we ensure that whatever instrument, whether it's a sovereign instrument or a private sector instrument, how do we ensure that we're going in the right direction in the long term and the proceeds are not used for change of direction? I think in debt for nature swaps, it's never the government that actually manages those proceeds and those funds. It's always an independent entity, and that really ensures long-term kind of that conservation area will be protected. And also in project finance for permanence, for example, that's really very large ticket size conservation funding in kind of hundreds of millions. And that is a very complex kind of organization where it's really a lot of different stakeholders, including the government, kind of contributing. And it's not just basically philanthropic capital or capital markets and or blended finance for conservation. It's really also funding and looking at what policies and what law needs to be in place to ensure really the permanence of these funds in this conservation work. So perhaps from those structures that, some of that could be used for kind of the private sector as well to as a structure to kind of govern use of proceeds. And then something to speak to your bond question, for example, I don't know if increasing premium is the right way to think, for example, of green finance in general. But something that we are seeing in innovation is we have this area called bankable nature solutions, which is basically, scaling projects or nature-based solutions with a bankability model. Or you have a collateral where you have kind of a investor risk return profile, etc. And where there's different blueprints for doing that. In most cases, obviously, it's blended finance driven. So of course you have your grants, but you also have kind of your bond and debt instruments that are facilitated. But there could be additional kind of layers of financial instruments in that blueprint that make the project more and more bankable and with a higher appetite for different types of investors, like your carbon credits projects, your like biodiversity credits, for example. Now that is an emerging discussion. So there are different forms of how innovation or different instruments can plug in to make better returns for investors. So we're almost out of time, but I do want to end with one last question. Perhaps to whoever wants to kind of answer. I'm sure probably all of you. But because we're talking about technology, and of course, blockchain, DLT, and so on is really an enabler. AI has also been an enabler for us to automate and really speed things up. We've seen the application in many things in terms of, applications such as supply chain traceability, such as other solutions for fragmenting instruments and making them more accessible for SMEs. But we have to also talk about the carbon footprint of these technologies. What do you think about this? Is this a potential future transition risk? Should regulators have a look at, how we're using this data? Should there be guidelines and principles not to kind of use it for, in excess with no actual impact and outcome? And also, how do we make it equitable, right? Because a lot of the developed world has access to these technologies and we're using them for fun, like testing things on ChatGPT, adding to the carbon footprint. But then at the same time, are we actually enabling global South players and for example, adding to financial inclusion and different solutions that they need much more than the developed world?
So just a quick one, since I've been in sustainability space since 2011, and back then we've seen like big companies starting to calculate their footprint, reduce the footprint and offset what is left. I do think that tech companies here and all those tech solutions, they are no different, and they should just follow the same procedures as the big companies and sustainability leaders were doing before. And those best governance principles and regulations should just cover all of these solutions as well. So it's a part of the economy and there is no exception.
Yeah, I've got one already. Thanks. Yes, I agree. And I would say, you'd be much better placed to talk about distributed ledger technologies, blockchain, and everything else, because that's definitely Evercity's wheelhouse. But on the modeling point and ChatGPT, when we work with these kinds of models, I think it's really important to bring together the people that can work with the models and the people who know that the domain that you're working on to make something happen, because no one needs to use the underlying OpenAI models and train it with the internet to do something specific. We can be so much smarter about the energy use by just, being really specific about when we run these models and with how much data. It doesn't need hundreds of thousands of data points or documents to tune to the level of accuracy of the results where it's actually usable, in our case, on financial services stakeholders that are interested in climate and sustainability. So we need to be clever. So I would say to anyone in the room or online, if you're working with startups, make sure that you look at the team, that they have the right background, that they're not just, ask them about the models, ask them how they're being used, how they're being trained, how they're being tuned, where the data comes from, how it's being stored and accessed, because that has a huge impact. It can literally be, if we did what OpenAI does in terms of training the models, we'd go bankrupt in about a day. Instead, we haven't yet. So I'll stop there.
Yeah, just briefly. I mean, I haven't really come across anything that only has an upside. Everything seems to also have a downside. It's just a matter of maybe comparing them. And, to give you one example, is also we all, get used to working from home and we do online meetings. We also have a lot of hybrid events now or just online events. But of course, when we use Zoom or Teams or whatever else, it's not just good. It's also where, of course, we're not very efficient. We're not super efficient either, because this is actually all energy that we're using. And again, we're polluting with that in a way. But is it better than flying somewhere? Maybe the comparison makes the difference. But yeah, hopefully over time, everything will get more efficient. Also coming back to bonds, we now have digital issuance. That's also not fully efficient yet. It's also, of course, a problem with the blockchain has been hyped for more than a decade, and there are up and downs, and one day it's good, one day it's bad, and it still has so many flaws and teething issues. But the good thing is that things are happening, and technology infrastructure will improve over time. It's also sometimes a chicken and egg problem. Banks, are developing the infrastructure, but then investors might not have it, or investors might have it, but then the issuers don't have it. And so there's a lot of good and bad things, but we just need to keep doing panels like this and, informing everyone and reading up on it and getting together and talking about it online or in person without emitting too many emissions. But yeah, so I guess I'm going to stop there.
Oh, go ahead.
Yeah. Let me also end on a hopeful note. The climate investing gap is huge. People, you keep throwing trillions of numbers. So I'm here for an inclusive COP. If a technology, hyped, not hyped, is helping in that progress, I'm all for it. If it is making it easier for me, let me take those steps and engage with the stakeholders to see where we can go. A perfect enemy of the good, we cannot wait for that. And the impact of climate change is not going to wait for anyone. So DLT, blockchain, any other technology, you name it, as an issuer, my perspective is to make it easier and more smooth, the issuances, green sukuk, green debt, what have you, to make it, to scale it up. If I'm not able to scale it up, then the money is not going where it's most needed. So yeah, inclusive for everyone. Thank you.
To end on, so no one opted for regulation. But I mean, to a certain extent, I agree that I think it is important for us to find a solution to scale these. Again, being smart and acknowledging that there's good and bad, but being smart about it and ensuring that even the technology, along with enables the funds to go to where they're most needed. So with that, we thank you very much for staying over time. Sure.
Particularly on this matter, I did a research and I published it, and I received lots of good feedback. You know, when we are talking about technology, like blockchain, yeah. So blockchain, we know that we got lots of benefit from blockchain as well, particularly on data matter. But at the same time, let's give you an example like Bitcoin. That because we are talking about good or bad. When I'm looking at the Bitcoin, because I did the research, 135 conservative annual electricity usage of Bitcoin. Yes. And that's, if you consider in Europe, Sweden, Norway, annual full electricity is less than this amount. Let me go to the Africa. In Africa, this is what I did research. In Africa, Kenya, 9, Tanzania, 7, Ghana, 18. The sum would be 35. So 135 Bitcoin. Let me add more countries on this. So Ethiopia, Uganda, and all of this country would be around 50, 1/3. So I would like to second what you said. There are good and bad. So take the good one in order to have a better green, and at least we can reduce as we are doing for others as well. Thank you.
Can I maybe just quickly jump in on this as the moderator? No, well, that's, I think, at least in our perspective, right? This is where technology really needs to come in, and a lot of actually blockchain and crypto issuers are looking at innovation, proof of stake versus the old method, right? So I think it's important to recognize the good players from the bad players, because indeed there's technology and then there's innovation of that technology and ensuring the carbon footprint is lowered, right? And in the EU, regulators are already looking at requiring carbon footprinting of cryptocurrencies and crypto miners reporting, right? So how that's done and so on is another matter. And so, you know, the whole kind of decentralized finance and data question is separate. But I think that again speaks to what Krista said as well around being smart about it. And I think calling also the players in the room which are not doing the right thing, calling them out.
Thank you for that. I do think it's important to disentangle cryptocurrency from distributed ledger technology as it applies to the stuff that we're talking about here. So yeah, maybe there's a kind of financial inclusion point, which you'll talk to in a moment. But my point was really more around how do we make the modeling and the DLT technologies in sustainable finance more efficient? And that can also be done through green bonds, by the way. As Simone was talking, I remembered we'd looked at green bonds where use proceeds include more efficiently cooled data centers, 80% emissions reduction compared to the baseline. So, hey, we're doing something right.
Dear ladies and gentlemen, on behalf of the co-hosts of this pavilion, I would thank you for a very active panel, very informative. And just like an ending point, we have also among co-hosts the HBAR Foundation, which is part of the Hedera blockchain ecosystem, which is a carbon negative blockchain, meaning they calculate their emissions, they offset their emissions, and they launched a $100 million fund to support technological use cases for green bonds, for carbon credits. So this is a great player, and we're happy to have them as sponsors of the Pavilion. So thanks again for all the speakers and the audience for very active participation. And we are wishing you a great COP. Thank you.
Thank you.